So today we will understand about the future or forward contract pricing. Okay. So normally when we have to price a contract, we do it on the cash and carry model basically, and based on that, or you can say the opportunity cost we lose normally due to not delivery of the product. So in a nutshell, I will say that if you are buying something and somebody is selling you something, or rather I would say you are you know uh, mm, actually going into a contract, so you are promising a person to buy something and another person is promising you to sell something. So what happens is, if you are taking the product's delivery after a month or let's say an year, so in that situation, you may have some opportunity cost involved with it. Let's say take a layman example. Normally we see the forward price or the future price is more than the spot price. So when the forward price is greater than the spot price, okay, so this situation is understood as a contango situation. Okay, and if the forward price is less than the spot price, we understood as a backwardation situation. Backwardation. So why the forward contract is priced more than the spot price? I'll give you an easy example. Let's suppose I am planning to buy a house and I go to a seller and tell him that I'm interested in your house and are you interested in selling too? So if he says yes, I'm interested, so next level is you negotiate for the prices. So suppose the seller is selling you for 1 crore. You said fine, I'm ready to buy for 1 crore. Okay, so I'm ready to buy at 1 crore. So the person is ready. So then he asks you the next thing, when you're gonna make the payment. So in that situation, the buyer says I'll make the payment after a year. Then you will not agree. In such a situation, the seller may not agree. Why? Because seller may ask you a question. If I sell this house today and if you deposit the receivings, the money which I got from selling, the remittance, if I deposit this thing into bank, I will earn an interest of around 9%. So I'll be losing that 9%. In that situation, the seller will ask the buyer if you want to take it today. So let's buy in cash, sell in cash. Okay. So the price will be for 1 crore. For the property would be 1 crore. And if you're planning to take the delivery after a year, in that situation, I'll be losing that interest opportunity cost. You have to at least give me that much. So that 9% you may have to bear. So in that situation, 1 year later, if you take the delivery, if you do the forward contract, in that situation you will put, if delivery date is 1 year later on, then the price you can quote may be 1 crore 9 lakh. Right? So at least this much, this is the minimum something a seller can ask for, because this is something which will definitely lose if he sell today and deposit that money into bank. He may get that much of return in India at least. So he will be losing that return. So he may ask the buyer to compensate. So in that situation, what he is looking for, so to price the forward contract, okay, this much should be the at least value of property. What will you do? In that situation, you will multiply the spot price with the interest you would be losing, the return, the rate, the cost of, capital, or you can say the required rate of return, or simple say the risk-free rate of interest, whatever it is you would be losing, that at least minimum you can ask from the buyer. So let's suppose the minimum you can ask is the risk-free rate of return. Okay, so let's say if the period is 1 year, you can simply take this thing, it's power, and this will be nothing. So here I'll get the forward pricing based on a simple compounding formula. So let's suppose the property price is 1 crore and the interest rate is 9%. Okay, so at the end of year you will be getting 1.9 crores, right? So that you would be at least getting for the future contract price, and the buyer must pay you this much. So in forward contract, normally if the contract is non-negotiable, non-further transferable, and the delivery will be on a fixed date, you can simply put this formula spot into 1 plus RF raised to the power T, simple compounding. But what if the contract is settled daily? So if I talk about a future contract, not a fixed maturity forward contract which is non-negotiable further. So if we talk about a future contract which is daily settled, in that situation you would be interested in paying the interest amount for only those period which you are holding the contract. Basically, this means that if a contract was launched on 1st of June and expiry is on, let's say, 30th of June. So if you're buying on 1st June, you would be paying interest for the opportunity cost would be for 30 days. And if you're buying on 10th of June, you would be interested in paying for only 20 days, because all the future contract has fixed expiry, that is last Thursday of the month. Okay. So you have 1 month contract which has 10 days gone and 20 days let's say remaining. So you would be interested in only paying the interest cost or the opportunity cost for 20 days. So in that situation, normally if 1 day passes, let's say if you are buying on 11th, then you would be interested in paying for 19 days. So same on the date of expiry, you won't be ready to pay any interest rate. So technically on the date of expiry, there should be no interest loss or opportunity loss. So forward price should be equal to spot price on the date of expiry, isn't it? Because आप कुछ hold कर ही नहीं रहे. There is no loss. So expiry is the delivery date, the last date of delivery possible. And on the same day you are paying cash and receiving taking the delivery. Let's say if you are interested in taking delivery. So there was no delay. So there was no opportunity loss. So in that situation, forward contract should be priced same as a spot price. But before that, at least you can ask the buyer that give me this much of opportunity loss, which I am actually might be losing if I'm selling this to somebody else, rather keeping it for you and waiting for you. So for 20 days, you should charge for 20 days interest. So we can say broadly, the interest on a future contract is compounded on a daily basis, right? So we have a continuous compounding on future contract. So for normally continuous compounding, we can use another formula, that is spot into exponential raised to the power r into t. So here r is risk-free rate of return, right? So hopefully you are getting till now. So if I place here, let's take an example. Suppose the spot price of Reliance company share which you want to buy in cash on National Stock Exchange, pay from your trading account and get the share immediately. Okay, so if you are trading in cash, that would be the spot price of share. So check the spot price of share. Let's say the spot price of Reliance is 800. Okay, and exponential, the by default value is 2.718. This is by default value. And R is risk-free rate. This R is, let's say, normally you can take the fixed deposit rate for 91 days for shorter contract, or you can take the treasury bills, 91 days treasury bill, RBI's treasury bill rate, and if you're into US you can take the Fed Reserve's treasury bill rate. And let's say if the contract is for, let's say, 1 year, then take 360 days treasury bill, or go for a government bond for 1 year, which is money market. Or if it is a long-term bonds, okay, and you want to take, let's say if it's a long-term delivery, let's say you want to book something which will be delivered after 10 years. So in that situation you will look for a government bond and the interest paid on that bond. So that should be taken as a risk-free rate of return. So basically the idea is the expiry of your contract, if you want to take the risk-free rate on that contract, you want to calculate, you have to take a similar kind of thing which has risk-free interest rate. So government bonds do not carry default risk. So normally if 10 years government bond has around 8% interest rate, so you can take the 8% interest rate for a contract which will mature after 10 years. So the contract's risk-free rate has to be similar, okay, and to the similar kind of government bonds maturity date. So normally our future contract expires after 1 month if you are buying a 1-month contract. So you look for a shorter term expiry government bonds or treasury bills. So normally government bonds or treasury bills do not carry default risk, or it is very minimum. So you take the interest rate given on the treasury bill as your risk-free rate. And if you really want to see what is the risk-free rate currently in India, you can go to the treasury, RBI website. Let's say RBI bank, and you will see the key rates, policy rates, everything here. You go to the Fed Reserve website if you want to check the Fed Reserve's key rate. So I come here and I'll see the market trends. We have 91 days T-bills, treasury bills. The interest rate is 6.7292. So you can take this as the risk-free rate on the future contract. Or else, if you don't know this thing, you can simply take the bank's fixed deposit rate for 3 months. That would also work fine. There's not great difference, but it will be slightly okay. So let's suppose 7% as the risk-free rate. Let's assume. Normally you have to take the exact one. I'm taking 7% just for the sake of easy calculation. And then you have to check the time. Time is basically time remaining till expiry. Okay, so this would be the time remaining till expiry. So let's say if you're buying a contract on 10th and the expiry is on 30th, so you have 20 days remaining. So let's say the time here in this case, I keep it as 20 days. So if we put it on formula, the forward contract price should be equal to, the spot is 800 into exponential, that means 2.718 raised to the power r interest rate, so that is 7%, into time. Time is 20 days divided by 365 days. Now why this? Because the interest rate here is given as annualized. The 7% is an annualized interest rate. So I have to take it for 20 days. So I multiply it with 20 and divide it by 365. Whatever price here you get, let's say I don't know how much you will have for a month, let's say 802. So this would be the forward contract price. I don't know what it is. You just have to calculate. I'm just randomly putting it. So whatever number, let's say X is here, would be the price for forward contract. Now this is the theoretical price. But in reality, on market, the actual price which is trading on, which is trending on the stock exchange may differ from the theoretical value. Now, if this is the situation, you can do cash and carry arbitrage. Okay, so I'll show you how you do a spot and forward, a future arbitrage or a cash and carry arbitrage. So let's check out a live example. So log in here. Now, so what I'll do is I'll open a market watch window. And I'll show you the spot price of Reliance, let's suppose. So Reliance Industries Limited. Now this is trading at 973. Now this is the current market price of the share. So we can call it the spot price also. Okay. Now I'll add it a derivative contract of Reliance. So I want to take the near one, and then I'll go for futures and go for Reliance. So this is Reliance 28 July. This is 1 month. And if I want to take the next month, I can go for a next month also. So this is the August one. We know that we have multiple days expiry for the same contract. So look at here, the spot price is 973. The Reliance share is trading at 980, and that is the July expiry, and August expiry is trading at 985. All the prices are different. Why? Because of the opportunity cost. So that's why the future contracts are priced little more than the spot price. And the situation here is a contango situation. Okay. Now let's calculate the theoretical value. Now this is the market value for the Reliance future contract. So if you want to buy one future contract, it will cost you around 980 rupees to buy one lot of future contract. And this is for 973. So this is the price for one share, and the lot size is 500. So you have to pay 980 into 500 into the margin amount. But let's not go for the initial margin calculation. Just see the prices. The price for Reliance share is 973 here, and Reliance future, which has an underlying asset, the same Reliance is the underlying asset. You can take the delivery of Reliance shares. So what is happening? You are buying a Reliance future which will expire in 28th of July, and you are promising here, if you are buying, that I will buy the Reliance share 500 shares at 980 each, okay, on or before the 28th of July. I'll take the delivery at this rate. Now, so this is the price for Reliance, which is trading. Now let's calculate the theoretical value. So I come here, let's put the share price. The spot price is 973, 973.45, fine. And the exponential value we know is 2.718. The rate of interest, let's take it 7%. Okay, I'm taking around the fixed deposit rate. And the time till expiry, how much time it is left. So 28 July is expiring, today is 1st, so we have around 28 days left. So I say here days as 28 days left remaining. Let's calculate the future price value. So I'll put the same formula here, equal to spot into exponential, right, raised to the power r, okay, into days divided by 365, right, and let's close the bracket. Now the value I'm getting is 978. Now this is the theoretical value, and here the value is 980. So this is 2 rupees overpriced. Okay, doesn't matter, 2 rupees not too big. Let's suppose if the spot price is 990, kind of that. So you might be getting almost 14% on an annualized basis on that contract. So that means on an average 1.5%, and on a monthly, let's say, basis, around 1.25% or 1.2% on a monthly basis. So in that situation, you could have, gone for a cash and carry arbitrage. Otherwise, if it is fairly priced, you don't have to go for a cash and carry arbitrage. So one thing you understood here, I'll teach you how do we go for a cash and carry arbitrage, but here I just wanted to explain how do we price the future contract. So the spot price is 973, the exponential we know, rate of interest we know, and days we know. So what did we get? We get the future contract price, which is the theoretical value, but actual market value is 980, which is 2 rupees overpriced. Nothing there. So it may be overpriced or underpriced. So when it is, greater than, the forward price is greater than the spot, we understand this is contango, right? And if the forward price is less than a spot, we understand backwardation. Then why do we have a backwardation situation? Backwardation क्यों होता है? That is the problem here. Backwardation क्यों है? We understand that why there is a backwardation. We understand that because of the opportunity cost, the future contract is overpriced. It's not overpriced, it's priced more than the spot. But then in what condition the future price is less than the spot? Now this happens due to expectancy theory. What do you mean expectation or expectancy theory? Let's suppose somebody is expecting, or most of the sellers or buyers are expecting, that after 1 month the Reliance will declare its quarterly result around 28th, and we are expecting that the result would be bad. Well, let's suppose you are a commodity trader. You are planning to take delivery of commodity potato after 3 months, and you're expecting that the price will be low after 3 months because of the oversupply in the market. There could be another reason. Let's say you're trading currency and you're taking an expiry date of 3 months later on, and you believe that the interest rate would be reducing and the currency would be, depreciating. So in that situation, what will happen if you believe that after 2-3 months the price will be lesser than today's spot price? In that situation, whatever contract you make today is priced lesser than the spot price. So that is because of the expectancy theory. So that is what is your backwardation situation. Now let's understand and take an example of cash and carry arbitrage. So let me open a simple case study. Now let's suppose the Reliance spot price is 970. Let's assume it's 973, I guess, right now on 1st of August, and on 5th it goes to 980, on 15th it goes to 1050, on 25th it goes to 1020, and on 30th it goes to 1100. It can go anywhere. It can go anywhere. You never know. Risk-free interest rate is 8%. On 1st, the time till expiry is 30th. On 15th, the remaining days is 15. On 25th, the remaining days are 5. On expiry, the date is no remaining day. So it's the expiry date. Now, if you calculate the theoretical value based on the future price, formula. Okay, so you're getting the value that is 976. Okay, and if you do put the formula into same cell, you will see here the difference here, 970 and 976, that is 6 rupees. That is the spot price and future price difference. So this is the opportunity cost, or the spread we call it. So this is spread between a spot and future. The difference between a spot and future contract price. So we call it a spread also, and this is, you can say, the opportunity cost also. Now, if we see on 5th of August, the spread is less. Why? Because there are less days remaining. Now here, theoretically, the spread is less. On a 30th day, technically, the spot price and the future price both has to be same. Theoretically, both has to be same. However, what do I notice is actual future price on the stock exchange is little mispriced, or it is overvalued. So the spread is 10 here. So this price is 980. So what do I do is, I know if I deposit that same money into bank, I'll get 6 rupees interest. Okay. So that if the share price is fairly, priced, the future contract is fairly priced, I'll not go for the arbitrage, because the same interest I'll get it from bank if I deposit the same amount into bank. That is what I get. So I don't need to go for an arbitrage. But yes, if I'm getting more return than the bank's return, I can go for the arbitrage. So I'm getting here 10 actually. So this is overpriced. So that's why I'll go for an arbitrage. So what I do is, on 1st August, when the price is 70 of shares, I'll buy shares. Let's say the lot size is 500. So 500 shares I'll buy. And I'll buy one lot of future contract, because one lot of future contract contains 500 shares. It has 500 shares. So I'll buy Reliance shares, 500 Reliance shares, and one lot of future contract at 980 and shares at 970. On 30th August, I see the share price went to 1100. So in that situation, whatever I bought at 970, I'll sell it at 1100. I make a profit of 130. And if I buy Reliance future, the Reliance future I sold at 980, I'll close that by buying that future contract. So you know that if you have to close the future contract, you have to buy the contract on the exchange. So first you have sold, now you're buying to close the short sell position. It's a short covering. Now this will give you a loss of 120. Why? Because you sold at 980 and price went to 1100. So this will give you 120 loss. So 10 becomes your profit, isn't it? So price went to 1100, you made 10 rupees profit. Let's suppose the price is going down. Let's say it goes to 900. Then in that situation also you make profit. Why? Because you bought shares at 970. You're selling at 900. You're losing 70. But something you sold at 980, the future contract, the spot price becomes 800, 900. So you sold 980 and you are buying 900, so you're getting 80 profit into short sell position. So net is 10 again. So no matter wherever the market goes, it becomes a riskless strategy. Okay, and the gap, the spread is your profit. The spread was 10 years, that much you are enjoying. If there is a mispricing on the date of expiry even, you won't be having great difference. That could be 0.001% or 0.01% or maybe kind of that. Fine. So here we are understanding the cash and carry arbitrage, right? So we took an example based on the Excel model, okay, and hopefully you got it. So what you have to do it on exchange, let's say if you want to get benefited from this, there's a difference of around 6 rupees. So what you do is you buy Reliance share 500 shares and you sell future contract here on the date of expiry 28th of July. No matter whatever is the market, the spot and share price most probably would be same. So what you do is you close the contracts, both the contract you close at the same time and you make profit. So you are buying this thing, you have to sell and close, and you're selling this thing, you have to buy and close, and wherever it goes, let's say it goes to 1100 or 1010. So this Reliance will be 1010 shares and future contract will be also 1010. Both will be same. Prior to expiry, let's say 1 month before, they may have mispricing. Why? Because of the interest cost. We just learned the formula for the interest cost and we have that one. So this is what we use, the forward contract pricing. This is what we used. So forward price equals to spot into exponential raised to the power r into t. The spot is the share price, exponential value is by default 2.718, interest rate is 7%, and time is time till expiry. So today is 1st and 28th is expiry, so we have 28 days. And let's say if you're buying on 10th, then you have 18 days remaining. So you will take days as 18. So in this example, okay, so here we try to calculate the future price. So we took 28 days. This is the theoretical value. Okay, and the actual value is 80, only 2 rupees overpriced. So what we would do here is we put the formula here and we're getting the value. So if days remaining till here is 2 days, the difference would be nothing. It's almost similar. The future contract and the spot price both may be almost same. Okay, because there is no interest cost. The longer the expiry, the higher would be the difference. Let's say the expiry is 365 days. So look at the interest, around 7% you have. So this would be the interest you will be losing, and this is on a continuous compounding basis, so that's why it's too high. If you go on a simple interest, that would be much lesser. So 41, so 3 rupees you are getting extra because of the continuous compounding, right? Anyways, so why do we do continuous compounding? Because the future contract can be settled on any date. Okay, so you can close the contract by going into an opposite position. Now, the example we took here, buying Reliance share in a spot and selling future contract. Remember, the numbers should be same, the 500 shares and the lot size. The lot size here is for 500 shares here, look at here. So the minimum lot size is 500 shares. This is here the quantity. So for a future contract. So you should have shares holdings into your demat account that has to be minimum 500 Reliance share. So make it equal. The quantity has to be same. If you buy one lot, That means you are promising to buy 500 shares into a future contract. But for that you have to pay only margin. That could be, let's say, uh, so 500 shares, and the 500 shares and the price is 973 into margin. Let's say I keep it 8%, then it is 38,938 rupees you have to pay. And if the margin is, let's suppose, 12%, then you pay to 58,000. And actually you have to pay, if you're buying shares, you have to pay the full amount. That comes around 4,86,725. So this much you have to pay to buy 500 shares. Okay, 500 shares, and to buy this thing you need to pay how much? Buy one lot of future contract, which contains 500 shares. You have to pay only 58,407, 58,000 only. So total investment will be around 5 lakh something. Anyways, so the interest in this case would be hardly percent, maybe a month, not more than that. But it is too much overpriced. Let's suppose I told you if it is 990 or 1,000, the difference is high. In that situation, you can go for a cash and carry arbitrage. That's good way. Now this position is called a hedged position when you are buying the Reliance share in a spot and the equal amount you are selling on future contract. So this becomes a completely hedged position. No matter wherever the market goes, your profit remains 10 if there is a spread, and if there is no spread, let's suppose there is no spread, this is not 980, this is a little different. So you're buying at 970 and you're selling also at 970. So there is no spread. If there is no spread, you have no profit. And if it's a negative spread, okay, so it's a backwardation situation, you can say. So let's say it 6-0. In that situation, you have a loss. Why? Because you're buying a costly shares and selling the cheaper ones. So here it must be more than the spot price. In that situation, you will make some money. But yes, this is a hedge position. In any case, you will not make more profit than 10, and in most of the cases, and your loss will not be more than rupees 10, or in most of the cases you will not have any losses. So kind of, if price goes up, your long position will give you profit. If price goes down, the short position will give you profit. So if price goes up, the shares price will give you profit, and at the same time Reliance future will give you a loss. So one's profit, another's loss will get compensated. Likewise, if share price goes down, the buy Reliance shares, you have taken the long position into share, it will give you losses. But the short position which you took on future contract will give you profits if the price goes down. So that again, profit and loss is compensated with each other. There is no extra profit, nothing like that. So this is called a hedged position. Okay, so we did hedging. Now, so how do we use it and why do we use it? Let's take an easy example. Why do we do hedging? So why do we do hedging? Why we do, okay, I'll give you a simple example. Why do we do hedging? I don't know I have given you previously or not. Let's suppose I'm an exporter, okay, and I calculated that the cost of toys is coming to 60 rupees per toy, and I think I should add some profit into that. So let's say I add almost 100% profit into that. So I'm pricing one toy for 120, and let's assume if the USD INR is trading at 60 rupees per dollar. Okay, then if I have to give quotation for 1,000 you know toys to importer, so I would be giving around this much. Okay, so 1 lakh, almost 20,000, and if I have to give it into dollars, I'll be converting into dollars, so that comes to around how much? $2,000, right? So $2,000 would be my quotation, okay, uh, for the toys. Now I'll get payment after 3 months, and let's suppose after 3 months the dollar price goes to 50 per share. So that means the USD INR is trading at 50. Your INR became stronger, 10 rupees. Awesome. This is not happening in practical, but let's assume for the sake of easy calculation. Now in this situation, what did you receive after 2 months? $2,000. And now if you convert that into INR, that's 50 per dollar, you're getting hardly 1 lakh. So straight loss of 20,000. Why? Because currency depreciated. But at the same time, what you do is, if you are fearful that the market will go down, okay, so what you do is the prices may go down or INR will become stronger. So what I'll do is I'll sell a USD INR contract at 60 on, okay, sell USD INR 60 future contract, okay, if the future contract I'm gonna sell on any stock exchange or maybe wherever I can do it. So what will happen in situation if price goes down? Obviously this thing will give you lesser profit. How much? This will give you only 1 lakh, but something you sold here and you're gonna buy at 50 the USD INR, the same lot will give you 10 rupees profit and you have almost $2,000 shorted. So you'll receive 20,000 from here. So both this together becomes your 1,20,000, so 120,000. So your profit is not going anywhere if the price goes down. Why? If price goes down, the future contract will give you profit. And if the price goes, it goes down, the future contract gives you profit. Even the spot, this amount which you received into spot, basically in cash, which you converted through bank, this is giving you 20,000 losses. That is recovered from here. And if you say, what happens if price appreciates? No problem. Let's say price goes up, price goes to, let's say 70. So in that situation, 20,000 into 70, this comes to 1,40,000. But because you have hedged here, if price goes to 70, you will have a loss. A loss of how much? Minus 10. The difference between 60 minus 70, that goes to minus 10. In that situation, if you multiply it by $2,000, the lot size, you may have a loss of 20,000. So if you reduce this 20,000 loss from your total income, you will still have 1,20,000. This is the amount you actually wanted. Then you will say, sir, if price depreciates, I'm making more profit. Why shouldn't I keep it, unhedged? So I'll have more profits. But what about if the currency appreciates, the price goes down? फिर क्या करेंगे? Now we have a doubt here from Avik Tulushan. You want to talk? You want to type? See, the prediction is based on technical analysis. The prediction can be based on quantitative analysis, the evaluations. You can get a fair idea if you read the newspaper every day. If the inflation is high into your economy, the interest rate will increase and the currency will appreciate. If you have higher FDI inflow, the currency will appreciate. But if your export is lesser and import is more, the currency will depreciate. So you will get an idea. So if you want to keep it hedged, you will be safer. And if you have no idea, if you keep it hedged, you are still safer. At least जितना आपका profit है, that is locked. So your profit is locked. It will not go with anywhere. Your 1,20,000. So because of the hedging. Okay. So this thing helps to exporters, to importers, to commodity traders, the stock traders. So many people, everybody gets benefited if you're using it appropriately. Otherwise, it will not give you any profit, it will not give you any loss. So there's nothing amazing you can get. Yes, if you're trading on spreads, we took the Cashandcarry arbitrage, you may get some month return, percent, maybe 1% a month. Okay. Now let's talk more about the hedging. Let's say I give you an example of commodity. Now, in case of commodity, let's say I'll give you an example. My uncle was a turmeric trader. I don't know what is the price for turmeric. I heard this story 4 years before. And he lost almost 20-30% into turmeric trade. And what happened? Let's suppose he bought turmeric for, let's suppose the price was a wholesale price. The wholesale price was 1,000 rupees per kilogram. Okay. And he was selling the same thing into retail with 20% profit added. So plus add 20%, so it goes to 1,200. So whatever is the wholesale price, he's adding 20% and selling it into retail. Okay, so that is what 1,200. Now what happened is, let's suppose this was on 1st January. Let's suppose on 10 January, he notices that the wholesale price in the market has reduced to 950. Now, if he would have been smart enough, he could have hedged the position. That was a big move, 5% down, and he was afraid that the price may go fall further. So what he can do is, on 10th January, after a fall of 50 rupees, he goes to MCX, that is commodity exchange. He will sell future contract. Okay, you have to see the future contract. This will be normally overpriced. Normally it happens because of the opportunity cost. Or you can be same. Let's suppose it is priced as 960. Let's suppose. So I'm selling the future contract at 960 on commodity exchange. Now I'll sleep peacefully. Why? My position is hedged. Now make sure the quantities has to be same. Let's say I'm in 10,000 quantities here, then I have to see the lots must be equal to 10,000 quantity. So here now I'm sleeping peacefully. What happens if the price goes up or goes down? Let's say the price went to 700. The wholesale price went to 700. So how much you will be selling for, adding 20 rupees profit? So retail price you will be selling, so you will be selling it for 840, adding 20% as the profit. Still you bought for 1000 and you are selling it for 840. So you will finally make a loss of around 160 here. Around 160 loss you are having here. Now let's check out the future contract, which you sold actually at 950. You sold, okay, and now you are buying at how much? 840. Sorry, the wholesale price becomes 700. It is 700. So I'm buying at 700. Right? The spot price is 700 on the exchange. So buying at 700, you sold at 950, and the wholesale price was at 950 on the spot. You sold the same contract at 960. Sorry, 960 you sold. Sold the contract at 960 when the price in the spot market was 950, and now the spot price in the market is 700. So your goods in your go down, which you bought for 1000, will give you a loss of how much? So you bought for 1000 and you're selling it for 840. Why 840? Because this is the retail price, and you bought for 700, you're selling for 20% profit. So the 840 is your retail price. So finally still you are having a loss of 160 because the wholesale price was 1000 and selling in 840, so 160 is loss. And at the same time you sold something on future contract, price went down to 700, the spot and future is same. You'll make a profit here of how much? You make a profit here of 106. I'm sorry, it goes to 260, isn't it? So the difference of 160 and 200 is almost 100 rupees profit you would be making, right? So even if the market went down, you are making 100 rupees profit. If you might not have taken a hedged position, in this situation almost you might have lost 160 rupees per kg. That means almost 16% of the capital might have gone because of this price drop, a 30% price drop. So hedging sometimes can save you from the unsolicited, volatilities, unexpected volatilities. So this sometimes can help you. So this is what as a commodity to spot, commodity hedging. Now let's suppose if the underlying asset is giving you some income. Now what do you mean by this? The stock pays you dividend and the house can give you rent, right? So let's say in the previous example, the seller said that if you want to take the delivery of house after 1 year, in that situation I will be charging you the interest cost I'll be losing. So let's suppose if you want to buy today, I'll sell it for 1 crore. If you want to buy after 1 year, I'll sell it for 1.9 crore. Okay, so that 1.09, that means 1 crore 9 lakh. So why I'm asking 9 lakh more? Because if I sell this thing today, I'll keep the deposit into a bank. After 1 year, this will become 1 crore 9 lakh at the interest rate of 9% in a year. Let's suppose. So if you want to take the delivery, I'll be charging you more. If you want to buy today, you can take it for 1 crore. Right? Then the buyer can give one, can point out that let's suppose if I pay you 1 crore today, the house will be mine and I'll be enjoying the rental income also. So if you're keeping the house, you're going to deliver me after 1 year, you are charging me interest cost. So why shouldn't I ask you, the rental income would be mine if I would have bought it today? So in that situation, to price it perfectly, you must subtract the income generating from the underlying assets. So in case of a spot, shares. So if you know the dividend, actual amount of dividend you're gonna receive, if you know, company normally has, that um, what do we call it? We have bonus, dividend declaration date, and we have one thing called we write it on that date. Whoever is holding the dividends, shares. Don't know what exactly what is slipping out of my mind. Basically, when company declares the dividend normally, and if you know the amount of dividend, so you can reduce that fixed amount from a spot price. So let's say if you know the interest the rent you're gonna receive would be 5 crore. So what you do is you remove that 5 crore from the not 5 crore, I'm sorry, 5 lakh. So rental income you're receiving is 5 lakh. You receive it from, reduce it from the spot price, and then you can apply the interest rate and all. So what you do is the income you're reducing to get the interest rate. Now, other way is if you don't know the absolute value, how much dividend you are getting on the shares. Okay. In that situation, you can, if you know the percentage, you can reduce that percentage from the uh, required rate of return or the interest rate, risk-free rate here. I'm so sorry, risk-free rate here. So reduce the income if you know in terms of percentage. So you know that the dividend yield, not the dividend percentage. Normally, if company says I'm giving 200% as a dividend, so this means 200% on face value. Face value normally of a share is hardly 1 rupee, 2 rupees or 10 rupees. So let's say if it's 10 rupees, then the company may give you 200% of this, so that is 20 rupees. And share may be trading at 400. So you don't have to take the 200% dividend, you have to take the dividend yield. So if you know the dividend is 20% you're going to receive, that is 200% of face value, then check out what is this. So 20% of 400 is almost 5% which you're going to receive. So 5% you're going to minus it from the risk-free rate. The risk-free rate is 8%, you minus 5%. So that means almost 3% you will be charging to calculate the future contract. Okay, so we reduce the dividend income. So likewise for commodities, we reduce the rental income. In currency, there is nothing like that. There is nothing you are getting as the income from underlying asset. So there is no cash flow from the underlying asset. So if there is a cash flow, you reduce that cash flow. So this was about the forward pricing and the future pricing.